Hello? All right. Thanks, everyone, from coming back from lunch. Hopefully, this will be an exciting, interesting panel and get everyone's blood moving again. Today's panel discussion is going to be on backing the next wave of Indian innovation, the VC perspective. We'll discuss with our panelists today lessons learned from the last fundraising cycle and adjustments being made for this one, new investment themes, including across deep tech, AI, and other key sectors. We'll talk a bit about developments and exit pathways, and then hopefully cover a number of other interesting topics. Before we dive in, we'll go ahead and we'll do a quick 60-second introduction from each of the panelists. Moving to my right, real quick, my name is Sean Murphy. I am an investment funds and asset management partner at Cooley. Cooley is an elite global law firm focused on technology, life sciences, and then venture growth and private equity. We work with funds doing over $100 billion in the last 3 years. We raised $3 billion in India alone the last 12 months, and likewise very active on the downstream financings. So we'll start right here to my right here with Tata.
Thanks. Good to be here. I run an early stage AI fund called BoldCap. I spent a fair bit of my time in the US, in the East Coast, and moved back to India in 2020 and launched. Prior to this was an entrepreneur, built in the B2B software space, and exited my company before launching the fund. We typically invest at pre-seed and seed. So typically first check into deeply technical Indian founders who are largely building for the global markets. Yeah, that's me.
Good afternoon, everyone. I'm Sharad Malpani, partner with ICICI Venture, and we are early growth private equity investors. Traditionally, ICICI Venture has done a lot of growth investing, and we look at multiple sectors, including consumers, finance, enterprise, and so on. We have also created a separate digital vehicle, the digital growth vehicle, which focuses more on the consumer tech, fintech, and the enterprise tech. Typically, we come at Series B, Series C levels. You can write check 12, 15 billion. The focus has been looking at lot of the new age businesses, the consumer segment, in the finance segment, enterprise, robotics. We have done multiple transactions. We've done in robotics. We are also actively looking at enterprise and a lot of new age segments. As a firm, we have sort of a very strong track record, especially focusing on the growth and working as more of a growth mindset with a lot of founders. Yeah.
Hi, everybody. My name is Padmaja Ruparan. I am a senior managing partner of Iron Alpha Fund and co-founder of Iron Group. We've been investing for the last 20 years, brought in the concept of angel investing, set up India's first angel investor group. While that business runs, we've set up a couple of funds, and we've been investing quite actively. Several multi-baggers sitting there in our portfolio. From our funds, as this is IVCA platform, primarily what we're looking and what we invest in is companies that are innovatively solving early stage, they're early stage companies solving real problems or those aligned to national strategic imperatives. We invest in Indian companies. We believe in Indian talent, and we believe that today there is a lot of innovation happening, deep technology happening here, and really kick-ass entrepreneurs who can make for India and for the globe. So today we have an horizontal platform, and entrepreneurs are able to raise from 1 crore to 50 crores with us.
Awesome. My name is back there. I'm the co-founder of Waterbridge Ventures. We invest from seed to Series C, broadly speaking, tech disruption. 8.5-year-old firm. Past life private equity in India for 10, 11 years. Past life venture in the US and so on. I think it's my last week for being the vice co-chair of IVCA's VC Council, VC Group. and therefore, also involved in the ecosystem, especially representing homegrown fund managers.
Hi, I'm Ashok, co-founder of Iron Pillar, one of India's early or growth stage funds set up way back in 2016. As the name suggests, we back entrepreneurs building from India for the world, primarily doing Series B, C, D. Two areas, enterprise B2B and vertically integrated B2C companies. Background is two-time entrepreneur and then 5 years across ICICI Bank and DBS Bank.
Okay, great. All right, well, this should be a good one. I feel like the stage is a little longer. You guys are further away than folks were last year, so hopefully we can all hear each other. One thing that I think is great about the panelists here is we've got folks with a lot of experience ranging all the way from angel and seed stages all the way through to late growth stages. So I think a lot of varied perspectives here, which will be helpful. So, Manish, why don't we dive right in, maybe set the table a little bit, some changes to the ecosystem since last year. What have been some of the key themes from last year and the lessons learned from the previous fundraising cycle?
Okay. So I don't know how many people are awake. This is right after lunch, but I'm going to do something different here today, if you allow me. I know we didn't get to chat about this. We're talking about innovation and venture. And it'll be really disingenuous of me to not do something different that touches the axis of AI. That's not amplified ignorance, that's artificial intelligence I'm talking about. In fact, we can take a bet on how many times AI will be used between today and tomorrow. I believe it's going to be a few hundred times at least. So what I did was, instead of the usual way of doing things, there were 4 questions I think the panel had defined. And just to tell the audience before I go into the attempted answer for this, I've been building a digital VC clone of myself. It's been maybe a year and a half of serious efforts in that direction. Tried all sorts of LLMs, finally sort of have settled in on Claude and Perplexity, a mix of those. And Claude Sonnet works for me. So what I did was, for this panel, I fed the 4 questions. And I know you asked me the market structure, what has changed. This was 45 minutes before the panel started. Okay, this is something new I was trying. And it's basically has given me 4 very bulleted responses. For this question, if you allow me, I'm just going to read the bullet points.
Sure, yeah.
Hopefully, it's going to be a reflection of who I am and how my digital VC clone is working. Okay,
and then we can compare it to how I use ChatGPT to prepare for this.
Yeah, and this is mostly, like I said, 70% Claude Sonnet and Perplexity, but they are more trained to be me. Okay. This is exactly, I'm reading verbatim. It'll be short. It'll be 5 bullet points for this question. Headline stat: 36 billion 2021 tourist capital era. This is venture capital investment. 24 billion 22. First cracks appear. 8 billion 23. 80% contraction. 12 billion last year. That's back to pre-COVID levels. Those are the headline stats. Okay, the points that Claude wants to make on this. First, the cause for the drop, near zero global rates, sent crossover funds like Tiger, Kotu, SoftBank back out of India. When the Fed hiked rates, they vanished. Second, the damage was felt in the Indian ecosystem. Baiju, Unacademy down 80, 90%, 100%. Farm-Easy, Ola down 50%. All of them were not necessarily bad bets. They were the consequence of underwriting growth without underwriting governance or unit economics. Point number 3, what permanently changed in underwriting is that even Series A is now priced on revenue multiples, not vision multiples. Unit economics, profitability, and visibility of that in 18 to 24 months of a Series A, that's the expectation now, what used to be a Series C expectation. Point number 4, 36% of Series A plus deals in 2025 were raised by 2x or 3x founder entrepreneurs, 36%. That number was 18% in 2020. So it's doubled, more experienced founding teams. 52% of deals in 2025 in venture were not Uber of India or ByteDance of India, they were uniquely India or India Bharat. Second last point that Claude wants to make, there is a barbell sharpening that's going on. Mid-market mediocrity is being squeezed out. Early stages, number of AIFs, just in the last year, 25, increased by 1,300 new AIFs, new schemes. Later stage capital also is quite prolific. Family offices like Ramdev Agarwal ji from Motilal invested 100 million of personal money in Zepto. Last point. As the cycle showed, India's dependence on foreign capital has increased or has reduced. 53% of CAT1 and CAT2 funds raised last year were from domestic capital. 53% of the capital raised by CAT1 and CAT2. So that's a shift, over 50%. But it's just CAT1 and CAT2. But the large capital still is with the Lightspeed, Speak 15s, Bessemer, so on and so forth. There are some green shoots in India with SIDBI's second fund. RDI is 1 lakh crore. We'll see when it comes in line. And the headline bullet at the end is 12 billion in 2025 in India is actually healthy. Tourist capital is gone. Structural capital remains and is growing.
It's a good summary. And now I know what Claude learned. My question, though, is what did you learn? What did your firm learn? So you talked about serial entrepreneur.
This is me. This is Claude's response. Every conference I go to, what I speak is fed into this.
Yeah.
Every presentation we make for fundraisers at Waterbridge is fed into this. So basically, these are my views and enhanced by, like I said, hopefully some artificial intelligence. But if you want me to summarize, domestic capital dependence has increased. It's also showing up, not yet. Institutional capital still not, but family offices are playing a big game. Founders are more experienced. India-specific business models are more prevalent than US or China equivalent in India. That the early stage is prolific, late stage is prolific, A, B, C, or more like B and C, big gap.
So let me pressure test two of
and
those.
Sorry,
and then we'll come to you.
underwriting is more on what used to be a Series C metric is now a Series A metric. Revenue multiples, show me unit economics. That's the summary.
So two things I also heard you say were that a much higher percentage of serial entrepreneurs, and also if we look at the cautionary tales, they generally were not governance driven, I think I heard you say. So in terms of lessons learned, how does that apply for the next cycle? Are you penalizing firms that don't have serial entrepreneurs because now you expect that experience? Are you conducting diligence as usual because you don't think there's governance issues in the last couple of years?
Sean, I can give an answer that might sound like the right answer, but the reality is in early stage, you're trying to pick alpha in founders, but founders are trying to pick you over others. I don't know how much of governance gyan you can give at the time of this selection process. I think the answer really is to each zone. From our point of view, our crystal ball of will founders be high governance people, will they care about the right principles, has always been important. I don't think it's important for everybody. But the point I'm making is that it's not something that you really control at the early stage. Having said that, there is a much greater focus as boards develop, as cap tables develop, because now we also have the not so good role models of, we know what not to do. There are many companies in India that have gone through this cycle. So that bit has changed. But in early stage, I want to be honest, it's your crystal ball and how much importance you want to put to it.
I just want to kind of give a contrarian view here. My exposure is all in North American markets, right? OpenAI's last round, $105, $110 billion round, is equivalent to all of venture capital in India for the last 10 years, put together, right? So one, I think that as a ecosystem, we are super undercapitalized, right? I think the second thing that I'm seeing in the US is the founder age in AI has dropped from 40 to 28. I'm talking about median. And like some founders are at 18. Some founders are at 20. No prior muscle memory to kind of building what they used to build to kind of come and push the frontier. So the most successful AI companies in the US, the age of the founders have dramatically dropped. And in the US, people prefer more first-time founders than second-time founders. The type of profile of founders used to be more distribution engineers. Think of Mark Benioff, think of Girish Mathrubootham. But now it has evolved to more researchers and deeply technical researchers and engineers. So has significantly shifted to that. And the fourth thing is, I think just on capital allocation, I think in 2024 it was 30% to AI. I think 2025 was 51%. Sorry, 24 was 51%. I think 25 is somewhere around 70, 80, 85%, right? It's just like, I know it's not my question, but I just thought that I will give a contrarian POV on, the US to India as like where we need to catch up.
The main thing I heard was that in India, I'm also now too old to be a founder, so.
I'll just like to add to that with, traditionally Indian market has been valuing companies based on maybe EBITDA or PAT. That's the very standard way of looking at the business. Obviously, we have seen early growth where people have started valuing companies on the revenue multiples. One of the key things that is also changing is traditionally we haven't valued IP. As a large set of the investors, whether into the venture capital space or the private equity space and maybe later into the listed space, valuing IP is going to be something that will happen over a period of time. We are seeing those abnormal valuations that we are seeing for maybe Anthropic or OpenAI and SpaceX. These are basically, if you compare them with the revenue multiples, I mean, you just can't make any sense. The gap is huge because there's a lot of IP sitting out there, and that's something which market is valuing. I see that change happening gradually in the Indian markets. And that will basically also give a lot of boost to the deep tech business. We are seeing, some of the sort of sparks where, the funds, growth funds have started investing into deep tech. I see this momentum picking up, and over a period of time, we will see a lot many deep tech companies getting funded.
Yeah, I actually tend to agree with Sharad to a great extent. I think not only are we seeing IP getting valued, I think TRL levels are getting valued. And I think that's very, it's a signal change because the perspective on research, the perspective on technology has sharply increased over the last few years. That's number one. Number two, I think there is a lot more assessment of the technology compared to what it used to happen 3-4 years ago. And hence, there's a lot of expertise which we would not have even touched upon, which is completely academician or researchers who we are touching base. And this is India focused, it's not US. US has been there quite a bit. And the third thing I think what has also happened is, at least that we've seen, we are investing in deep tech companies, as I mentioned. When we invest and we evaluate, we are simultaneously trying to think, how can we cash flow the company through debt or RDI, etc. And that makes a big difference because then your valuation multiple suddenly changes, right? You're not just doing a one-dimensional valuation. So the downside, of course, is where the valuation does get impacted, unlike the US to a great extent, is Indian entrepreneurs are very good on technology and it's only improving. We're seeing a lot of foundational technology talent here. But the business side, even simple financials, is missing in many companies, which means that we as partners or as the AMC or the GPs have to put in a lot more work, and there is a value to that, right? So a like-to-like company in the US may have got a better valuation in that sense compared to here, because there is that quote-unquote input which is non-financial, which is coming in beyond funding. But it has been a huge change. You know, if you even go 5 years, or even down to COVID, which is 5 or 6 years, there's been a completely dramatic change to what it is. And it has taken much more peeling of the onion, but I think also there's, you know, what Manish mentioned about companies going under. I think it has helped to improve entrepreneurs coming now, because I think they keep thinking about EBITDA, they keep thinking about cash flows, they keep thinking about what they can do better to become slimmer in that sense, right? Have less burns. So when there's things don't work, I think the next lot of people learn from that, and that's happening, which is very good to my mind.
So having observed those changes, and maybe sticking with Pamaja for a moment, having observed those changes, how does that play out for investment themes going into the future?
Yeah, I think as a VC, unlike perhaps an angel or unlike perhaps a single individual, every fund manager has to think about risk mitigation. I think especially so in early stage, because the risks are so high. So at least what we have seen over and over again, that sector agnostic is a good idea, right? So your theme is never health, at least we don't have a healthcare focused or an education focused or a deep tech focused. We have to shuffle all the cards in, because that gives us two things. One, it helps to risk mitigate your overall fund. Plus, to be very practical about it, we consciously look at shorter gestation companies versus longer gestation, so that LPs start getting some returns, right? And I think it's very, very important to quote-unquote manage that. Because even the LP ecosystem today in India is nowhere comparable to what you would get in the US. And I keep doing the US because I think it's the easiest comparator. Second is, I think what we've tried to do is keep a bottom line theme that we would like to invest from the fund primarily in innovative solutions, solving real problems. So you'll see us in water, you'll see us in sanitation, you'll see us in agriculture, you'll see us in or biotech, semiconductor, space tech, drones, etc. Or those that are of strategic importance. So we would have done something like defense tech, for example, right? So we are trying to build a thesis which is slightly differentiated. So about 70% of our money would go there. And we would still do the balance 30%, which is not deep tech, so it will be AI, but it's still solving a problem. You know, it could be healthcare, for example, connectomics also. So that is one piece. The second piece we are continuously trying to see is the entrepreneur. Because at the stage that we invest in, it is the entrepreneur. So in the entrepreneur, we are always looking for complementary teams. We don't always find them complete, but we are very clear that we are looking for that. And the third thing that I think I have seen a change on our platform over the last 15 years or so, is the fact that we used to build proprietary deal flow. I think today we are looking at themes where we can bring in more co-investors, because we are finding that it is much more risk mitigated. You know, more heads on the table, more money on the table, next rounds are easier. So, and the last piece that has become very interesting is the family office, which I think Manish sort of touched upon it. We don't see family offices purely as an LP base. I think, yes, there are some which are LP based, they are passive, and that's fine. I mean, money is always welcome. But how much value can that particular family office or institution help us? And that helps us to drive many other things in the fund. So a lot of the heavy lifting that we may need to do in a company, we try and actually get them in, because they know the space better than us. So I think it's become a much more holistic, integrated investment strategy, rather than saying, it's my deal, I know what to do it, and I will invest. So it's moved from I to us to a great extent.
I'd be remiss if I didn't focus, as Manish did, on the increasing focus on AI. I mean, as you said, you guys are quite diverse. I think a number of you guys all have quite diverse portfolios, both in terms of stage and in terms of sectors. BoldCap's obviously very focused on AI. And certainly co-investments, family offices can be helpful from a strategic side, or when you're gobbling up capital the way that AI does. Maybe so we can come back and chat a little bit about, you're all evaluating opportunities in AI. Are these opportunities where it's a strategy effectively to go into the US? Are we looking at models or localization here? And if it's mostly overseas, what's missing here to drive more of that investment domestically?
I think, okay, so I wanted to set some context, right? Anthropic added about $6 billion in revenue last month, right? Just $6 billion in revenue, right? If we internalize that, I think, and why some of the companies, trillion-dollar companies, to your question, like to your point on OpenAI growing, I think like OpenAI's and the Anthropics of the world are growing, and I think we're going to see a lot more trillion-dollar companies. 5 years ago, if someone had said that, you're going to build a trillion-dollar company in 5 years, nobody would have believed that. Today, it's becoming possible. One of the things that we fundamentally focus on as a venture fund, we think that we live in what we call as a generational opportunity. We believe that, we have told ourselves that we are not going to go for safe bets. We are not doing $1 to $10 billion outcomes. So most firms would also want to see India outcomes 1 to 10 billion, which is what's been historic in India, apart from some select that have kind of moved past that threshold. We want to be in the next Anthropic. So one of the things for us to be prepared if we need to invest in the next Anthropic, we've identified a few themes that we believe are going to be critical. We've done about 20 odd investments so far across our funds, which have raised a little over $200 million from global institutional capital. So the typical themes that we invest in are 3 buckets. One is autonomous work. We believe that within autonomous work, there are 2 categories that are there, right? One is AI services. I think India has a true opportunity to kind of go and disrupt itself. We are sitting with the talent, we are sitting with the knowledge, the tribal knowledge, we're sitting with customers, we're sitting with all of the capabilities in-house. We should disrupt ourselves, and that should be a primary responsibility. I think we also, within that, we look at everything for what we call as an AI worker than a co-worker, right? We believe that today there's just a lot of spend on productivity tools, but I think these tools replacing yourself is going to happen in the next 3-5 years. The other thing that we do is we intentionally invest in frontier labs. We think that frontier lab investments can be done by seed funds from India as well. And we are not a very large fund, but we have done frontier lab investments, which has also raised significant downstream capital. So it's possible. So I push everybody to kind of think of 10 to 100 billion outcomes and not self-select yourself out of it. The other thing is the last bucket that we invest is in real-world AI. I think the physical AI component, I think, is something that we still haven't experienced ourselves. Look around ourselves. There is just a lot of opportunity to automate everything that people are doing today. And I'm sure as a race, we are all very smart. We would find other better things to do, probably spend more time with the family, right? So I think the one thing that's probably missing is, I wanted to set the context of where Anthropic is. I wanted to set the context of where we invest. But what's missing is capital that can fearlessly go and back these most ambitious founders. And I think that comes from, if you look at the Valley, I think it comes from, they've seen multiple decades of outcomes that have panned out with these technical teams going after very, very large companies like, the last decade of Databricks, another 100 billion plus company, and there are a lot more in that bucket. I just think that we have to, forward deploy ourselves. We need to forward invest because our talent capabilities are very clear. We do have good global best, in the global best categories. So I think it's a mix and match of capital risk appetite. I think this is not the time to optimize getting from 1 million to 3 million and being profitable. This is the time to go from 1 to 25 million, 25 million to 250 million in revenue and build the first billion-dollar company in the next 2 years, right? I think like there is significant opportunities that we see at least as the world opens up. So
I just wanted to add something. I think Satya makes a very, very moot point that this is the time. The talent is sort of developed. But honestly, I think what we are seeing change, especially in deep tech companies, which is long gestation, pre-revenue companies, which means they are very early, and or IP-based companies. I think we are seeing a lot of money in early stage, honestly. I mean, there is deal after deal that we are finding more money. We are getting pushed. The founders are getting pushed to take more money, right? So that also is a signal that there is money out there, be it whatever entity it comes from, family office, individual. But investors are now willing to bet in companies which are such high risk and much larger than they need, much larger amounts than they need. And these are companies which are built in India, knowing fully well that they are going to grow in India, right? And I think that's a big, big change. So Indian tech talent is being valued. And I think the research and science and the focus that we are putting in is starting to sort of open the doors of investors. But it's not at the same traction level that we would see in the US. But I think it's moved dramatically.
If it's going to go in a different direction, I mean, I know, like Ashok, I think you had like an operating partner background. Manish, I think you said you have private equity background as well. Is the talent is here, the technology is here, but is the experience here, and is that something that some of the larger funds or folks with operating backgrounds can kind of help bring to that? It may develop in a different way, but nonetheless kind of fill in those gaps so that there can be more sort of confident fundraising in AI and deep tech and robotics here domestically.
Are you asking me or Manish?
For Ashok and Manish.
So first of all, we have not seen any breakout AI companies come out so far. We are just waiting and watching. And Satya's optimism is there. He's seen the US market. I don't think we have seen it in our stage and in the growth stage. So on the question of talent, obviously it's there both on the VC side and even in our stage, where founders are basically tech founders. They may know their product very well, but every other aspect, finance being number one, sales, business development, brand building, all these suffer because these founders who are engineers, they want data, and every time they'll have to fail to realize something, right? So we lose time. That's how the time gets lost, right? So if your team is better prepared, if you have operating partners with you who have some experience in having done that and burned their fingers, it's definitely going to speed in the path, but founders have to be ready for it, right? They should be ready to listen and then take the advice. Right? That's the biggest thing. You can take the horse to the water, but after that, yeah.
Do you guys also speak on that, or less so, or? Yeah. So the last thing I want to touch on.
Can I just there's one point that I think is important. Just talking from an India context perspective, right? I think what is lacking is there isn't enough customers on the software side which is willing to put $100 million of their budget. Like if you're an Infosys making $50 billion, TCS making $50 billion in revenue, $10 billion in profitability. Like when the mindset shifts from me building to me like kind of giving this contract to somebody else, I think that's where I think India would inflect in software. I think that's a very important point that I just wanted to
Satya, the problem in India is that the make versus buy question always falls off at 20% of margin. Right? It's
the other issue for sure is what I'd like to cover last is this is all theoretical until you get to DPI. So exits has been driven increasingly by the public markets. Increasingly, we see continuation vehicles. We have some easing, hopefully, on the debt side, right, for M&A, which might drive more there. Ashok, maybe we could talk a bit more about how we see exits driving, because ultimately that's what's going to drive more capital to be available in the opportunities in the first place.
Yeah, so 10 years ago when we wrote our first PPM, we never had IPOs as an exit, mechanism, right? And today, over the last 4 years, IPOs have been driving a majority of, companies in our portfolios exits, right? Bluestone, Sedimac, and now Cure Foods, which has already got its approval, and a couple more, right? So we also managed to list one deeptech company in the US on NASDAQ, a pre-revenue company. It took a lot of hard work. I think it's about evolution of the ecosystem, right? So as the ecosystem evolves, you will have to get to these exit mechanisms, paths, continuation vehicles, which are now coming because again of regulation, right? So there is a SEBI regulation and end of life. You cannot cross that, right? And then how do you then transition one portfolio to the next, right? So these are all. So just this, like they say, innovation drives regulation, regulation drives innovation. So these set of exit paths will come about as we mature as an ecosystem. And it's becoming clearer that IPOs, which nobody thought would happen, right? Zomato, Paytm, all these companies listed. Indian retail investors supported this, right? There's $5 billion of, I think, retail money coming into the markets every month through SIPs, right? So that's a big number, right? And
just one quick follow-up there. We've seen relatively broad sector participation in the public markets as of late, but given how much the public markets are a pathway to exits nowadays, is it a case where the pathway to exits on a sector basis is driving some of the investment decisions, or is the assumption that the innovation is going to drive the public markets so that it's going to be there no matter what?
No, I think public markets don't care about sectors, or it's more about the financial metrics, right? So as long as there's predictability of revenue, there's certainty of revenue, there's certainty of growth, certainty of EBITDA, certainty of PAT, they are willing to reward you, right? So if at all there's any differentiation, if there's innovation, it should be either seen in the top line or the bottom line, right? That's how the market, views it very, very dispassionately, right? So.
I'll just like to add here that the public markets are also sort of evolving, especially into the new age business. We haven't seen the loss-making business getting values of tens of $billions in India, which is now also happening. So people are looking at a different matrix. I mean, the supply of new age is going to be there. Like if I compare with the US, 25% of the market cap is coming from the new age businesses, while in India it will be just hardly 3-4%. So there's a big gap there, and we expect like many new age companies to get listed on the markets. We also expect like, we haven't seen any pre-revenue companies getting listed in India. Well, it's very common on the NASDAQ to get listed. While we are some time away from it, but maybe next 5 years, I won't be surprised if there is a serious IP and then that company is getting listed on the pre-revenue basis. So we are seeing those evolution happening here.
Two quick points. One, look, if venture is supposed to support innovation 5, 10, 15 years out. If you start chasing what the IPO market is pricing today as an early stage backer, by the time you get there, that cycle is gone. So I don't think that's the lens venture can really use. The second thing I'll say is that, look, the 150, 160 billion of new market cap that got created over the last 4, 5 years, 50 companies, the reality is that the average listing, the average number of years it took to listing from founding was 13.4 years. Most funds are 10 years live. So to your question, therefore, secondary solutions and continuity vehicles, it's just a sort of part of life that the venture industry has to accept, grow into, mature around.
Yeah, I think, normally if you look at it in any, forget IPO, regulation follows innovation. And regulation has been following innovation, right? You've seen an evolution, be it SEBI, be it RBI, be it any regulator. It has sort of, whatever the market needs, it's sort of evolving. I mean, we never invested earlier, 10 years ago, 12 years ago, whatever that is, into IP portfolio companies. We never did. We always looked for top line, bottom line. right? We are investing. And I'm sure that will also come in for listing IP portfolio companies. So to my mind, I think just as we as an ecosystem have been sort of evolving from the entrepreneur side, from the investing side, debt has evolved, listing has evolved, and it will continue. So I think it's just where we are. That's it.
Overall, very upbeat. For fear of receiving another gong, I will thank the panelists for their time and their conversation today, and hope everyone enjoyed it after lunch.
Can I just use the opportunity to thank the regulator? We have some people from SEBI here, some senior people, because if they hadn't changed the regulation around listings of non-profitable companies with a path to profitability, none of this would have happened. So we absolutely have to, you know, if you want to applaud, we have to applaud for our regulator for supporting AIFs, the industry regulation, and also IPOs of tech companies.
Round of applause for regulatory foresight and exits. Yes, thank you.